All right. Well, I don't know how to start off this video because it's going to be kind of doom and gloom. I never made a video like this before. I've never done as much research as I've done on this video, or at least more critical thinking than I've ever done. But it's going to be about the coming short-term economic climate that we're going to be facing in the next 6 months to a year. And I've been looking into it more recently because, I have a family now. I have a wife, I have a dog. And when you have those things, you want to make sure that your family's going to be okay. If you hear that crunkling, that's my dog playing with her toy. But it's you want to do what you can for your family. And right now, what I want to do is I've done what I needed to do to protect myself for the next 6 months to a year and beyond, really. And I want to do that for people on YouTube. So everyone's been talking about inflation, how inflation's going to wreck the U.S. economy. And looking at what Jerome Powell has been saying for the past 6 months, it's very clear to me that people don't understand what inflation is. Even reporters who are asking Jerome Powell these questions, and he's answering them incorrectly based on just common financial knowledge. I think the markets have been correcting properly, and I'm going to go over, first off, what's been causing inflation so far. So, obviously everyone knows it's the money printer. The Federal Reserve has been printing money and lending it to the United States government to spend as willingly as they would like. There's also been a couple other things like a lack of commodities. So a lack of steel, a lack of food, a lack of energy, so electricity, heat, water. All these things will increase the price. Like if there's a lower supply of those things, the price will increase. Commodities work that way. So if there's less water, if there's less energy, if there's less food, those prices are going to go up. We've been seeing that with the war in Ukraine. Wheat prices have skyrocketed because those two countries, Russia and Ukraine, are some of the top exporters of wheat in the world. And although in the United States we make a lot of wheat, we produce a lot of it, just because we make a lot of it doesn't mean that our price is dictated by what we're producing. It's dictated by the entire world. So because we're in a global economy. So lack of commodities, because we need more commodities than there are being mined or being harvested or whatnot. Also wage growth recently. Wage growth, although contrary to popular belief, yes, wages have not been rising with rising prices, but that's because we've created this weird environment where we've allowed equities and bonds to raise in value. Chloe, what are you doing? Chloe, calm down. I'm telling my dog to calm down. We've been seeing wages rise extremely high in these past 2 years. And that's bad when you have a low supply of goods, because you have more people spending money. Not only that, you have more people who have access to more liquidity in things like assets. They have more access to credit, and the more credit that they have, the more that they can spend above their income limit. So instead of having a $130,000 income, somebody has a $10,000 credit card limit, they now have a $140,000 income. That's what they think. That's the artificial wage. But it's not true, because they have to pay that back. So as you see consumers stock up on their consumer debt, which has been happening, during the pandemic, people were paying down their debt because they have all this money coming from the government. And they said, oh, well, I have this credit card. I'm going to pay it off. I'm going to make a smart decision. I'm going to save money in the bank. But now they're not doing that. They're spending more than they make. Because is it because of the rising prices in commodities? Because of the rising price in oil? I don't think so. I think people want things. I think people are being very gluttonous right now with their money. And so because the economy is doing well, people are going to go out. People are making more money. They have more access to credit. They can afford higher credit card bills. They can afford higher auto bills, auto insurance bills, auto, loan bills, things of that nature. So, but that goes into my next point is access to credit. The more access you have to credit because of the lenient Federal Reserve policies, the more money you can theoretically spend that's not yours. And then there's the big one that I think everyone has been ignoring for the past 30 years, 40 years, since the decline in manufacturing in the U.S. is the lack of innovation and productivity. And the reason I believe why this is the case is because in the 70s, we had high inflation from OPEC, generally because of probably monetary policies that were incorrectly in place. And because of these higher prices, companies did not want to train employees to produce goods. They wanted to get more into the United States, and companies wanted to start selling services. And so we became more of a service-based economy, and we outsourced the hard stuff to the labor to cheaper countries with less wages, with lower wages. And so that is really what is driving up inflation, is because we're relying on other people to produce the foundation of our innovation. So we put that in the hands of other countries and other companies. And when those systems fail or don't meet their end of the bargain, like China, then what are you going to do? All right, so there's that. So all of these things that have caused inflation, they led to a lower supply of goods and services. They led to outsourcing of production and productivity. And they've inflated the equities, bonds, markets, and inflated the national debt. Because we got lazy, basically. We stopped innovating at a rate that was appropriate for growth. And to compromise for maybe it wasn't negative productivity. Maybe not. I don't know. We will never know for sure. Because we can only make models and predictions of what could have happened. We'll never know what actually would have happened if we did not inflate the market in 2008 and pretty much before 2008, ever since like the late 80s. We'll never know what true GDP would have been. Now, where was I? Well, with all of that being said, it has led to an increase in debt, in the price of equities and bonds, because where are you going to put that money to work? I mean, you have all this money, and you don't want to actually increase home building. You don't want to increase job hiring, increase, incorporating businesses. So where are you going to put the money? Well, I don't want to do so much work. I just want my money to work for me. I'm going to put it in equities. I'm going to diversify my portfolio, buy some real estate. I only want to build 3,000 square foot homes on the coast of California. I think that's a good investment, because then I can sell that home for $3 million, and it only costs me like $1 million to make. Yeah. So, And then real estate firms, they'll they'll make commission 200 grand more on that sale. So you see how it's a positive feedback loop, and then supply dwindles. And that's part of why supply has dwindled, is because there's no incentive to produce more housing. And even if people produce more housing, everything else has gone up in value. And companies aren't going to build unless they have a profit margin. And construction companies have had the worst profit margins in history, typically. They can range from 1% to 6%. But I believe recently they've been making more, closer to 10 to 20%. And so they're cashing in on it now, knowing that later on they'll probably go out of business. So what does everyone expect to happen? Everyone right now is expecting inflation to go haywire. Runaway inflation, hyperinflation of goods and services. Now, what will actually happen? Is this the Fed's policy that they're enacting? And it's not the Fed's policy. They're not trying to do this. You don't want to fight the Fed. Now, that being said, obviously you don't want to fight the Fed. What is the Fed saying? The Fed is saying, what Jerome Powell has said, is that he wants to combat the high demand for labor by what exactly? He wants to, without saying it directly, he wants to lower the demand for labor. And how do you lower the demand for labor? Well, there's two ways. One, people die, or people retire, or people exit the workforce. They stop looking for jobs. Or two, companies go out of business and there's no companies to hire people. So you're artificially deflating, this is a big word, deflating the demand for labor. So deflation is going to be the Fed's goal. And this is the reason why. It's deflation that we're going to experience. We're not experiencing inflation. The only way that we would ever experience inflation is if the Fed backed out of what they're saying. And what's different about between 2018 and now, is that Janet Yellen's not talking. It's Jerome Powell. Jerome Powell is not talking. And I think when Jerome Powell and Biden met, they were agreeing on what was going to happen, and Biden and Jerome Powell were both preparing for what's to come. Because every country right now wants dollar bills, or at least there's two ways of thinking about this. Allies want dollar bills, okay? And non-allies don't want dollar bills. You have the side where people believe that the dollar will get stronger, and you have the side where people believe the dollar will get weaker, or that there will be some kind of economic collapse. So what do? China has been buying gold and commodities from the United States and other allies of the United States in exchange for cash. So they're trading out their US dollars for commodities, physical items, okay? So the United States theoretically should be hoarding cash. You have the Fed buying US securities, selling US securities. So the Fed is selling bonds, mortgage-backed securities, assets for cash. So think about that. They're selling stuff for cash. So they're taking money out of the system. That's their QT. That's what QT means. There's other ways of doing QT. You can burn money. All right, you can burn money. You can stop selling. You can stop printing money. Taking money out of the system is essentially what it is. So you can burn it. You can trade things for money. So they want to acquire cash, which is their goal right now. And they're raising interest rates. When you raise interest rates, what does that do to money? It does not devalue the money. It increases the value of the money. Increases the cost of borrowing, which strengthens the currency. Okay? Economics 101. If I have less money in the system, if I have less money flowing around, it's worth more. It's better to keep it in my pocket. So, what I suspect is going to happen is a recession. And we'll get the numbers July 28th, around July 28th. I believe is when quarter two GDP will come out. We'll have a technical recession. They've changed the meaning of recession, I believe, from negative GDP, consistent negative GDP, to a lack of productivity, which is very lame in my opinion. Although, because you can't really measure productivity. So, we will see a recession. What the recession will do is it will probably turn into a depression, but I can't estimate that particularly. We will have a bear market, and we will see tons of businesses go out. Zombie companies will go out of business because they can't afford to finance themselves out of their current financing. Basically, they only take out what they need to survive. Take out loans. And so they survive off of the loans. They cover the minimum payment. And if they can't make more money, which they won't because it's a recession coming. So if they can't survive right now off of their operating cash flow, they're screwed. So we'll see zombie companies, we'll see other companies go out of business. We'll see people lose jobs, and people will start to make less money, essentially, what will happen. People will make less money, and although we will see prices come down on goods, and these are not commodities. Commodities are like food and metals and things that you build with, things that you eat, things that you power. We'll see like consumer goods go down. So like IKEA furniture, for example, computers, consumer goods, Peloton bikes, I don't know, whatever you think you can't eat, you can't build with, you can't power with, that kind of stuff is going to go down in price. And I think prices will stay low because nobody's going to want to buy those things when commodities increase in price. Food is probably going to increase by 20% in the next year, food prices. I say that because of the droughts that have been occurring in California, as well as poor farming techniques that have been used for the past 100 years. They're starting to deteriorate the soil, and so farmland is starting to become unusable, as well as a lack of clean, fresh water. That's going to affect commodity prices. And then you're going to have oil, and oil is going to have a very bumpy ride. But in the end of the day, even though people won't be driving as much, we're still going to need energy to power things. And I don't think there's enough energy out there. And I think we're going to see that with the commodity prices starting to rise. I think commodity index funds will do very well. And they have been doing very well for the past 2 years. The investors have already found it. Okay, at least institutional investment firms. I should probably preface this by saying that I graduated with a degree in finance, specifically in institutional investment. So I was supposed to work for a Wall Street firm. I ended up working for an IT consulting firm. This is like my pastime. So what can you do to protect yourself, I guess this is all doom and gloom. People will make less money. There will be less money floating around, and people will lose their jobs. People will hopefully not starve. I hope there will still be, at least rice and beans on the counters, and hopefully some beef and chicken. But I haven't looked into the companies that produce those kind of goods, if they are equipped to survive a depression. Companies like Apple and Amazon have stockpiled billions of dollars, and Microsoft have stockpiled billions of dollars. I'm sure they're going to weather the storm. Microsoft has doubled the salaries of their employees to keep them. I don't know what they're doing, honestly, but my educated guess is going to say that they're going to do fine. And you also have to think about this. Does Apple really need to lower the price of Apple Music or iCloud storage? Are those prices as elastic as the price of, goods, consumer goods, and commodities? I don't think so. I think you may see more deals, but I don't think you'll see the main price come down. Same with Netflix. I don't think Netflix will never decrease their price. They can't, for a couple reasons, because they have to keep producing content. And the content gets more and more expensive the more you produce. So unless they're going to start paying the actors like $15 an hour, I don't foresee that happening. They will add ads, like they said, they can add ads, and you can pay a premium service to remove those ads, but it's an add-on. But I guess going back to what I was saying earlier, I was supposed to get into what you can do to hedge yourself. And there's a couple things. I think commodities, in my opinion, will go up, can double or 4x in the next 10 years until supply can catch up back up to demand. So I think there's that. So investing in commodities will be good, whether it's holding physical resources or it's investing in, indexes or, companies that produce those goods. That's up to you. There's also very risky things like options. If you believe that there's a recession coming and there's a deflationary environment, bonds and equities should drop. So you would want to buy put options against those. Personally, that's what I've done. Is I bought some cheap put options, and my time horizon is 6 months, because I really truly think before December shit's gonna hit the fan. So that's what I've done. Another thing you can do is Another risky thing you can do is shorting stock, but I would not recommend that. So shorting specific equities, specific bond funds, you could do that as well. Other thing, the most practical thing that anyone can do right now, pay off your freaking debt and save cash. Hoard cash like you depend on it. And really the hoarding cash part should have been done at the beginning of the year. But if you can scrape together cash, do it now. Because in a recession, if you try to sell anything, it's going to be worth less, way less. You try to sell anything in your house. You try to sell that watch you bought. Watches have been appreciating like mad, but they're luxury good. People have been buying Louis Vuitton bags and Prada bags. Those have been appreciating a lot. But in a recession, they're worthless. No one wants to buy that crap because you can't put food on the table if you buy that crap. Unless you want to go into debt. Luxuries are screwed. Bet against those. Sell your watch now. Sell your car now. Because I will. It's going to be, it could be as bad as April 2020. Could be as bad as March, April 2020. It could be worse. And it would probably take 2 years to fully hit rock bottom. Because the Fed's going to keep raising interest rates. Because I kid you not, when the recession hits and all those people foreclose on their mortgages or their auto loans are screwed, they lose their cars, the rich people will buy that crap up. The people with money will buy that up. People who think that the interest rate's still low will buy that up. And then the Fed's going to raise it even more. Raise those interest rates more to keep the rich people, the top 10%, from buying all the assets that just got open, that just got, on that, oh my gosh, I can't speak, that are now available to them. So I don't know how long this is. Oh my God. Okay. That's my 2 cents. I'm going to try to make a little bit more of these videos more often. But I just don't have time to edit. I've got to do all this research and I've got to work. I work, 60-hour weeks sometimes. So I've got other things. I've got a family, but, yeah, I hope this helps someone out there. And who knows, maybe I'm completely wrong and the Federal Reserve backs out on their decision and we go into hyperinflation. Who the frick knows, right? I hope that doesn't happen. I think I'll talk for a little bit more about why deflation, and this is another positive note, I think, in my opinion, why deflation is better than inflation. In inflation, you can't catch up with prices. Money becomes worthless. And there's no limit to inflation. Inflation is infinite. Inflation, you can go to the number Google, you can go that high. It's infinite. Inflation's infinite. Deflation is not infinite. Deflation has rock bottom of 0. So the only way the only way to avoid inflation is to go down. Deflation. And deflation has a bottom. You can't go any farther on your losses. There is always an upside to deflation. You can always come back up to that high. Properly go back up. But inflation, you cannot catch up with the rising prices. And in an inflationary environment with low supply that we have right now, it's totally worthless. People are tired. The consumer sentiment has dropped dramatically. People are tired of inflation. People don't want it. And I think the Fed has learned from the 70s and early 80s that is the case. We have to avoid it. So they're going to take the deflationary route. And the deflationary route, people may lose their jobs, but I honestly think it will encourage innovation. It will encourage productivity. People will find a way. We will come back and rise from the ashes because we're the greatest freaking economy and country that's ever existed on this planet. So I honestly think that everything dropping in price will be extremely helpful for the American people. If you drop from making $20 an hour to $15 an hour, but at least the price of food isn't going up anymore, I think that's better than making $20 an hour and watching food prices rise 25% year over year. And your wages are only rising one time every year. Because companies only raise wages once or twice a year usually. And prices rise continuously. Prices don't just rise once or twice a year. So I think it will be better in the future. Anyways, I'm just a dude on YouTube. See you guys.